starting with a small trading account is often framed as a disadvantage, something to get through before real trading can begin. Yet trading literature written by long-term survivors reveals a counterintuitive truth. A small account, when approached correctly, is one of the greatest teachers a trader can have. It strips away illusion early. It removes the fantasy of hiding mistakes behind size. Every decision matters, not because the money is large, but because the margin for error is honest. A small account exposes behavior faster than a large one ever could, and growth strategies at this stage are less about multiplying capital and more about shaping habits that can survive scale. The first and most important growth strategy with a small account is redefining what growth actually means. Many beginners equate growth with percentage returns alone, setting unrealistic targets that push them toward overtrading and excessive risk. Experienced traders know that the real growth in a small account is behavioral. Can you follow rules consistently? Can you size positions correctly even when the dollar amounts feel insignificant? Can you sit through periods of inactivity without forcing trades? These questions matter far more than whether the account grows quickly. A small account magnifies discipline just as easily as it magnifies mistakes. Risk management becomes non-negotiable at this stage. With limited capital, one poorly managed loss can erase weeks of progress. Trading literature consistently emphasizes that survival is the first objective, especially when starting small. This means risking less than feels necessary, often far less. Fixed fractional risk, strict daily loss limits, and an absolute refusal to swing for the fences are not conservative choices. They are strategic ones. A small account does not forgive impatience, but it rewards consistency quietly over time. Another essential strategy is focusing on process over profit. Small accounts tempt traders into thinking they must trade frequently to grow meaningfully. In reality, frequent trading often accelerates fees, mistakes, and emotional fatigue. Traders who succeed with small accounts trade selectively. They treat each trade as practice and execution rather than as a payday. Trading literature often frames this phase as apprenticeship. You are not here to extract income. You are here to prove that your behavior is repeatable under pressure. Income comes later when scale is justified. Expectations must also be recalibrated honestly. Compounding works mathematically, but emotionally, it unfolds slowly. A small account growing steadily will feel underwhelming at first. This is where many traders abandon discipline and chase returns. Growth strategies that work at this stage accept slow progress as a feature, not a flaw. The trader who can tolerate modest gains without increasing risk prematurely is already developing an edge that most never acquire. One of the most powerful advantages of a small account is the freedom to make mistakes cheaply. Losses hurt, but they do not destroy. This creates an ideal environment for journaling review and experimentation within strict risk boundaries. Trading literature often notes that traders who start with large capital learn slowly because errors are cushioned. Small account traders learn fast because feedback is immediate. Every loss carries information, and every win tests discipline. Another growth strategy is choosing simplicity deliberately. Complex strategies, multiple markets, and excessive indicators overwhelm small accounts quickly. Successful small account traders narrow their focus. One market, one or two setups, one clear risk model. This simplicity reduces cognitive load and allows repetition, and repetition is where skill is built. Scaling complexity before mastering execution is one of the most common mistakes at this stage. It is also critical to separate lifestyle goals from account reality. A small account is not meant to replace income. Treating it as such creates pressure that distorts decision-making. Trading literature repeatedly warns that desperation is incompatible with probability-based thinking. Growth strategies that work begin by removing urgency. The account is allowed to grow at its natural pace, while the trader grows faster in skill, patience, and emotional control. Over time, something subtle but important happens. The trader stops obsessing over the account size and starts focusing on the quality of decisions. Drawdowns become smaller. Equity curves smooth out. Confidence shifts from hope to evidence. This is the moment when a small account stops feeling small and starts feeling sufficient for the task it was meant to perform, which is to train behavior, test discipline, and build a foundation strong enough to carry larger size later. And it is right here, when the account is still modest, but the mindset has begun to mature, that real growth quietly takes root and continues forward, even though the sentence itself has not yet fully reached its end. Because once the mindset shifts from extracting money to earning the right to scale, the small account becomes a proving ground rather than a limitation. This is the phase where patience is tested most severely. Progress is measured in inches, not leaps. Many traders quit here not because they are failing, but because success does not look exciting enough to justify the effort. Those who persist learn a critical lesson. Boring consistency is the rarest skill in trading. At this stage, growth strategies revolve around protecting the account from emotional overreach. One of the most effective practices is keeping position sizing deliberately small, even after winning streaks. A few successful trades can create the illusion that risk can now be increased safely. Trading literature consistently warns against this impulse. Scaling should be tied to equity milestones and sustained behavioral consistency, not recent performance. When size increases are gradual and rule-based, confidence grows without distortion. Another important strategy is using the small account to refine execution under real conditions. Slippage spreads partial fills, and execution delays matter more than theoretical edge at this scale. These frictions teach realism. Traders who master execution with limited capital are better prepared for larger size, where mistakes are more expensive. The small account is where mechanics should be perfected, not rushed through. Journaling becomes especially powerful during this phase. With fewer trades and smaller stakes, each decision can be reviewed deeply. Patterns in behavior stand out clearly. Are losses clustering at certain times of day? Do mistakes follow wins? Does discipline slip when the account reaches a new high? These insights are invaluable. Trading literature often emphasizes that the trader who understands their own patterns early gains a durable advantage later. There is also a psychological shift that must be acknowledged. As the account grows, slowly, external validation is absent. Friends do not notice. Social media comparisons feel discouraging. Growth strategies that work at this stage deliberately reduce exposure to noise. Focus turns inward. Progress is judged against personal benchmarks rather than others' highlight reels. This internal orientation is essential. Comparison is corrosive when compounding is slow. Over time, the small account teaches a form of confidence that cannot be faked. You begin to trust yourself not because the numbers are impressive, but because your behavior has become predictable. You know how you will respond after a loss. You know when you will stop trading. You know that you will not violate risk limits even when tempted. This self-trust is the true capital being built. When size eventually increases, it arrives into a system already trained to handle it. Eventually, there comes a quiet moment when the account reaches a level that could justify scaling. This moment is rarely dramatic. It does not feel like arrival. It feels like permission. Permission to risk slightly more, to expect slightly more. Not because you want to, but because you have demonstrated that you can. traders who skip this stage often struggle later. Those who respect it find that growth feels natural rather than stressful. In the end, starting with a small account is not about how quickly you can grow it. It is about whether you can become the kind of trader who deserves a larger one. The strategies that work here are slow, unglamorous, and deeply effective. They build discipline before ambition process, before profit, and resilience before scale. And when the account eventually grows, it does so on a foundation that has already been tested under constraint, making that growth far more likely to endure, because the trader who learned to survive and improve with little is far better equipped to do so with more. If this reflection on growing a small account resonated with your current stage, consider subscribing to continue exploring the long-game principles of trading. And leave a comment sharing one discipline you are consciously strengthening while your account is still small.